Hello, everyone. Welcome to the webinar. My name is Linda Williams, and I am a Community Outreach and Training Manager with Consumer Action. Thank you so much for taking time out of your day to join us. I am so excited about the conversation that we get to have today about credit reports and scores. I am just so pumped. Is your credit report light blinking? It's time to check those credit reports. And there are so many reasons why we need to convince our clients to check their credit reports, specifically the recent data that exposed the personal information of millions of T-Mobile users. Remember that one? It was a breach that could result in fraudulent accounts being opened and potentially going undetected except through what? A credit report review. Also, if consumers opted for forbearance or deferment programs for their student loans, rent, or mortgage payments, they may need to check those credit reports to ensure that those delayed payments are being reported correctly. Joining us today for a conversation on credit reports and scores from the CFPB is Dr. Heather Brown. Dr. Brown would discuss protecting your credit during a pandemic and why it is essential to check your credit report. Also joining us from the CFPB is Dr. Ryan Sandler. Dr. Sandler will discuss the CFPB's finding on credit report disputes. It appears that disputes are far more common in majority Black and Hispanic neighborhoods. I'm interested to hear that. We're also thrilled to have joining us Chi Wu, an attorney from the National Consumer Law Center. Today, she will discuss pay now, pay later loans, and she will explain to us how the loans can decrease a consumer's credit score. She will also discuss her recent testimony before a housing committee on financial services on the proposed overhaul of the credit reporting industry. It's going to be a blast. So take out your pen and your paper, so you can take a few notes and buckle up because it's going to be a great webinar. Now, before I get too excited, I need to go over few housekeeping items. As the announcer stated, you are in listen-only mode. But you can use that question function on the right of your screen to type in your questions. We love hearing from you. So at the end of all presentations, Outreach Trainer Nelson Santiago, he's going to facilitate a question and answer segment. So this is where we get to hear from you. So please take a minute, find that question function so you can send Nelson a ton of questions. Now, this is a 90-minute webinar, and it is being recorded. You will receive a link to the recording, as well as the PowerPoint slides used today, and a few handouts no later than tomorrow afternoon. Now, this is really important, so I need you to listen carefully. At the end of the training, you will receive a survey about today's webinar. We value your feedback as we work diligently to improve our service to you. So if you have a comment, a suggestion, or even a compliment, we would love to hear from you. So please complete those surveys before signing off. And as a bonus, as always, for attending our training, you will receive a certificate of completion. Now, before I go any further, I need to take a moment to thank our sponsor and update you on what's happening at Consumer Action. Now, this webinar is presented as part of Consumer Action's COVID-19 educational project. Funding is provided by Chase, and I would like to take this opportunity to thank Chase for their continued support. Now, what's happening at Consumer Action? What do we do at Consumer Action? Well, as it says there on the screen, through education and advocacy, we fight for strong consumer rights and policies that promote fairness for all consumers, but especially for underrepresented consumers nationwide. At Consumer Action, we are proud of all of our work, but we are especially proud of our COVID-19 education project. When you're on our website, click on that middle reddish little link, and you will land on our COVID-19 project page, and you will not be disappointed. You will find resources that you can share with your client community that will help them navigate the COVID-19 financial crisis. Click on the words webinar, and you will land on our YouTube channel where you can review some of our past and very popular webinars, some receiving over 2,500 views. Click on the word fact sheet, and you will find a variety of topics that you can share with your clients. We have fact sheets on identity theft and account fraud during COVID-19, fair housing rights, estate planning, financial help for undocumented workers, just to name a few. Check it out. Go to www.consumer-action.org/COVID-19 to learn more. Now, let me review the agenda with you today so you know where we are headed. This is where we're going. At Consumer Action, we believe in making learning fun. We open up each and every training, whether it's virtual or in person, by testing your knowledge on the topic of the training with our most popular game, How Much Do You Know? Today, we have 3 true or false questions that are related to the discussion today on credit reports and scores. Following the game, as I said earlier, I will introduce you to our guest professionals in the order that they will be presenting. A question and answer segment, as I stated earlier, led by Nelson Santiago, will follow all presentations. I will come back. I will tell you how you can donate to Consumer Action, and I will wrap up. So now, with that being said, let's roll out the game. Let the game begin. This is how the game is played. We have 3 questions. All are true or false. I will read each question, and you will use the poll function to answer each question. Once the poll is closed, we will take a look at the results, and I will tell you if the statement is true or false and why. At the end of the game, now the person with the most correct answers, he or she get to walk away with the bragging rights to say it with me, how much do you know? So are you ready? Let's go to the first poll question. True or false? You're entitled to 1 free report a year if you're unemployed and plan to look for a job within 60 days or if you're on welfare. Now, is that true or is that false? Don't overthink it. Don't overthink it. Come on, let's close the polls and take a look at the results. 43% of you think that statement is true. 57% believes the statement is false. Well, listen up, 57%, because that's true. According to the FTC, you are entitled to a free credit report if you are out of work and plan to look for a job within 60 days, you're on public assistance like welfare, your report is inaccurate because of identity theft or another fraud, or you have a fraud alert in your file. And you will hear more about credit reports and scores from Dr. Brown lately. You're doing great. So let's move on to the next question. Okay, true or false? You can block identity theft related debts from appearing on your credit report. Is that true or is that false? You can block identity theft related debts from appearing on your credit report. Is that true or is that false? Don't overthink it. Don't overthink it. Okay, let's close the post and take a look at the results. Oh, wow. 50% of you actually believe that statement is true, and only 44% thinks it's false. Wow, 56%, you are correct. According to a fact sheet that will be in the items that you receive tomorrow afternoon with the PowerPoint slide, according to a fact sheet released by the Treasury Department, consumer reporting companies will block fraudulent information from appearing on your credit report if you send them a copy of the identity theft report and a letter telling them what information is fraudulent. The Consumer Reporting Agency has 4 days to block the fraudulent information after accepting your identity theft report. You're doing great. You're doing good. So let's move on to the last question, please. Okay, this is our final true and false question. Checking to see if your child has a credit history at age 16 and then thoroughly reviewing it can help you spot signs of identity theft. At age 16, is that true or is that false? Checking to see if your child has a credit history at age 16 and then thoroughly reviewing it can help you spot signs of identity theft. Is that true or is that false? Don't overthink it. Okay, let's close the polls and take a look at the results. Oh, wow. 80% of you believe that statement is true and only 17% thinks it's false. Well, 17%, listen up, because that is true. According to the FTC, checking to see if your child has a credit history when they turn 16 and then thoroughly reviewing it can help you spot signs of identity theft. And if you find false and inaccurate information, it will give you time to correct it before your child applies for a job, a student or auto loan, a credit card, or a place to live. And if you like me and you're looking forward for that kid to move out, check that credit history at age 16. Okay. Thank you so much. Thank you so much for playing the game. I really hope you enjoyed it. Now, are you ready for the beef? Are you ready for the featured presentations? Well, let me introduce our first speaker to you. Our first speaker is Dr. Heather Brown. Dr. Brown is a financial education impact specialist for the Consumer Financial Protection Bureau, the CFPB. She's working in the Office of Financial Education, and she manages the Financial Education Exchange, FinEx. Dr. Brown has over 18 years of experience in adult education, marketing, human resource, and project program management. Prior to working at the CFPB, she was a contractor Office of Comptroller of Currency, and she owns her own training business. Dr. Brown earned her doctoral degree in adult and continuing education from Virginia Tech. She has an MBA from George Mason. She has a JD Juris Doctorate from Concord Law School and a BS in Management from Old Dominion University. Wow. Welcome to the webinar, Dr. Brown. Also joining us from the CFPB is Dr. Ryan Sandler. Dr. Sandler is a senior economist in the Office of Research at the Consumer Financial Protection Bureau. Before joining the Office of Research, he served as a staff economist at the Federal Trade Commission and the Bureau of Economics, working on consumer protection issues. He holds a MA and a PhD in economics from the University of California, Davis. Welcome to the webinar, Dr. Sandler. Also joining us is Chi-Chi Wu. She's a staff attorney with the National Consumer Law Center. Chi-Chi at the NCLC, Chi-Chi focuses on consumer credit issues, including legislation, administrative, and other advocacy. Her specialties include fair credit reporting, credit card, refund anticipated loans, and medical debt. Before joining NCLC, Chi-Chi worked in the Consumer Protection Division at the Massachusetts Attorney General's Office and the Asian Outreach Unit at Greater Boston Legal Aid. Chi-Chi is a graduate of Harvard Law School and Johns Hopkins University. She is also the co-author of the legal manual, Fair Credit Reporting, and a contributing author to Consumer Credit Regulations and Truth in Lending. Welcome to the webinar, Ms. Wu. Now, let me turn this webinar over to Dr. Brown so that we can learn more about credit reports and scores in the COVID-19 economy.
Thank you so much for that warm welcome, Linda. And thank you so much to all of Linda's staff that helped support us as we got moving with this. And also I'd like to welcome my colleagues as well that are also presenting. I don't know how Chi-Chi Wu is finding time with they have their annual conference, and I was just in a session that she was moderating yesterday, so I know she's busy, but we're all glad to be here. All right, so we're going to get started, and I'm going to do an introduction to our FinEx program, but first I'm going to read through a quick disclaimer that I have to cover, and this disclaimer is for both myself and Ryan. This presentation is being made by a Consumer Financial Protection Bureau representative on behalf of the Bureau. It does not constitute legal interpretation, guidance, or advice of the Bureau. Any opinions or views stated by the presenters are the presenter's own and may not represent the Bureau's views. This presentation includes references to a third party. For the third party references in this presentation, we do not guarantee the accuracy of this third party information. We have not vetted any third parties, and we do not endorse the third party. There may be other entities or resources that meet your needs. Those are for things that are not our internal website. This document is used for a live discussion, so if you share it with others, it may not accurately reflect the topics that are covered. All right, so moving forward, I want to just talk to you quickly about how we're structured in our consumer education division. We have some special populations we work with. My program, the CFPB Financial Education Program, focuses on financial practitioners, which are many of you that are here today. And we also have a division that focuses on service members, veterans, and their families. There's a lot of special consumer protections for them, and they have a rather large group that focuses on that. We also have a group for older Americans, their family, and caregivers. And then our Office for Community Affairs focuses on underserved and economically vulnerable consumers. We have a very robust K through 12 program as well. And we have a students and young consumers group that focuses on college-age students and young adults. So when you have a special need for a particular population, all of those divisions have speakers. They have special information. Each of them have different sets of publications. So feel free, if you have a need in any of those areas, you can email me. I'm going to show you my the email address you can reach me at shortly, and I'll put you in touch with the right person. We have the CFPB Finex network. Some of you may be members, and if you are, thank you for that. We have over 36,000 members now. And for those of you that aren't members, you can go to this link and you will get a copy of these slides, I understand, from Linda, and you can sign up to become a member. And there's going to be some other links you'll see as well. So you can, at the end of my introduction to our program, you can take a picture of that slide. We do send out information on personal finance news, research, tools, best practices, anything that we think is relevant to practitioners. We push that out directly to that list. And you will also get notified for all of our webinars. I've been doing about 10 to 20 webinars a year, similar to this one that Linda's doing. And you're welcome to sign up and get notices and attend those. Everything that we provide is free of charge. And then we often have regional meetings and conferences in non-COVID times. So that's something else that when things get better, you'll have an opportunity to participate in. And so it's a great network, and it doesn't take a lot of time. You can sign up and come to what you feel like and ignore what you don't. This is a screen print of our coronavirus pandemic page. It's been very popular. It's very robust. It's updated regularly. Usually at least weekly, something new is put up there. It also links to the White House Coronavirus Task Force, the CDC, and Health and Human Services Task Force. So you can get a one-stop shop here and get all the information you need on the pandemic. We also have specific information on mortgage and housing assistance, as well as managing your finances. And these are kept up to date with what's going on with forbearance and eviction moratoriums and all of those kinds of things. So if you need information, I refer people to it. I go to it to answer questions for people that I can't answer. I encourage you, everything that I tell you today comes from our website. So please feel free to visit it and educate yourself. And you can just learn tons. And I continue to learn from reading through our website. We also have every publication that's available in print is also on our website as well. Okay, this is the practitioner's landing page. I'm not going to go into a lot of detail, but when you land on this page, you can enter your email address into this dialog box and click sign up, and that's how you become a member of the CFPB Finex program. This is another page related to practitioners and financial education for adults. And if you see, it says webinar training here in the middle of the page. You can click the link right under that says explore past webinars. And we have over 50 webinars that we have recorded and posted along with the transcripts and slides. You're welcome to take those slides and use them for your own purposes. Only thing that we ask is if you take our logo, if you change it, that you take our logo off of it and put yours on, because we want them to stay as they are if our logo's on it. But if you want to adapt it for your own needs, you are welcome to borrow any or all of our content and use it. That is the purpose of it. And our goal is to put information out and help leverage our resources by working with people like yourselves that actually work on the front lines with adults for the Finex program and teach them about financial literacy. Okay, this is just what it looks like when you land on the page where the webinars are. You only see 2 here, but if you scroll down, you'll go back as far as 2015 and see all that we have, and we're updating them constantly. There's 2 more that need to be put up in the next few weeks, hopefully before the holiday. And then you can get the transcripts as well, in case I didn't mention that. So this is a great page. If you will get the slides, but you can just take a screenshot of it. It covers the links that I talked about, the coronavirus page. The second bullet shows you how to, where you click to go get publications for free. We have bulk publications that you can order if you're doing training classes, and they can be shipped to you at no cost, and you can use those for classes. And many of them are very nice bound books, or we have a toolkit for a lot of the slides that we're going to cover today. And most of the slides that we cover today are coming from things out of our Your Money, Your Goals toolkit. And so I think you'll find the resources on this bulk copies page very helpful. We also have multiple languages. So you can look on this for all the resources available and request to have one or more shipped to you. The third bullet is the email address for the FinX program, and I do manage that box, so I try to check it at least weekly, but usually I try to hit it at least daily. And so if you have a question, you need additional information, you can email that box and I will get back to you as quickly as I can. And the next one is our LinkedIn discussion group. You're feel free to go there. Once you request to join, I'll admit you. I usually admit people in, in batches every couple days or at least weekly. And then you can post things on the discussion group. I know that Linda did post this webinar there, so maybe some of you came through that. If you did come that way, that's great, and please feel free to post things for yourself. And the last one is our adult ed general page for the FinX program. So what we're going to talk about today is what is credit, why does it matter, and we want to talk about how lenders go about checking your credit, how you can help clients build their credit wisely and build your own credit wisely, how you can protect your credit and help your clients protect their credit, and what do you do if your client or yourself run into credit problems, how do you rebuild? And we'll also talk about, for those that may work with people that are credit invisible or have young people in their home that maybe don't have credit yet, how do you start building your credit? Okay, so first talking about what is credit and what does it matter. I'm not going to actually do the polls because it does take time and I have a lot of information I do want to cover and get through and leave time for the other presenters. However, I will just run through it and you can think in your head of what your answer would be. So would you rather have a perfect credit score or $50,000? When I'm talking to non-practitioners, they almost always say the money. I would expect this group might say the first one, the A. But the idea is that your credit is an asset. And so $50,000 sounds good, but if you have a very strong credit rating ongoing, you can save much more than that, probably over the life of your career from what you pay in interest. So the purpose of that question is to remember that, your credit is an important asset, just like your cash flow, just like your job and other things that you have. And there's a lot of research out there about how much more people pay that have poorer credit than those that have good credit. And I've seen everything from, in the tens of thousands per year on down to maybe as low as, 3,000 to 5,000. But it is a significant cost when you have low credit. It costs you more to do things when you're looking for loans and other things we'll talk about. So we know that credit is your ability to borrow money. It basically is the credit report is a rating. The credit report is your history of your payments, whereas what's on the credit report is often your debt as well as strong things. The difference between credit and debt, of course, is that debt is what you owe and credit is what monitors how you're paying back what you owe. So when you want to avoid saving for something, people pay with interest and use credit for the purpose of that. And that can be a good thing if it's done well and you manage your credit well. But it can also be detrimental, of course, if it's not. So, of course, examples of things that are monitored on credit and ways that, your credit is reported are through mortgages or home equity lines of credit, installment loans like student loans, auto loans, personal loans, revolving bank accounts like bank credit cards, store credit cards, and other personal lines of credit. And of those three, the third ones have the most impact on your credit when you I won't say the most, but can have a very significant impact on your credit when you use them incorrectly or when you have too many of them. And of course, credit's not free. We know that. It comes with interest and it can be quite high. So if you don't pay attention to that, it can really lead to detriment as well as, other challenges. So there are consequences if you don't manage your credit well, like high fees, debt collection, lawsuits, and negative credit reporting, which can take a long time to overcome, but can be overcome. So we'll talk about how that can be done. Of course, the stronger your credit report and score, the lower the interest rate you're likely to be able to obtain and borrow. So if you have some people will say, well, I'm not planning on getting loans. I don't like to borrow money, so I don't really need to worry about my credit. And that is not true because there's so many things now that look at your credit and it impacts your ability to do business in a lot of ways around your personal finances and other things. Of course, getting a mortgage or any loan, your credit's going to be looked at. Typically, most lenders want to see a credit score of 620 for a mortgage. The FHA has a lower credit limit for it, but the lenders get to set theirs, and many of them determine that's the risk they're willing to take. There are some that will get you a mortgage for less, but you're going to have much higher interest rates. Now, a lot of jobs will check a credit report or a consumer report, including pretty much every federal, state, and local government job. And if you have a security clearance, it's really important to have strong credit, because you can lose a clearance because of credit, because they look at that as a security risk. Why? Because people perceive it can enable you to be bribed more easily and influenced more easily. And this is really important for military personnel, because I understand around 1,400 to 1,500 military personnel are discharged each year because of poor credit. And when that happens, of course, that leads to challenges for us and national security. So it actually, having strong credit is a national security issue as well. And getting an apartment or any kind of home, people will usually look at your credit rating. And also getting insurance now. Most auto insurers look at some sort of a consumer report or credit report. And additionally, there are also for homeowners that try to get homeowner insurance can also look at that. And recently it's become very difficult to get homeowner insurance. So these little things can make a big difference. Now, I just would add, there are some programs for rentals now. It's becoming more and more prevalent. It's something that consumer advocates have pushed, that people that are paying their rent on time should be able to report that just like someone paying a mortgage. So that is happening. And if you know of somebody that's renting and that's not occurring, they can ask their landlord if they're willing to do that and report their mortgage out and get assistance with that. And that can make a big difference on a credit report as well. You also get lower deposits on utilities, and particularly cell phones is one that there's some big variations based on credit reports. And getting a credit card, of course, makes a difference. So all of these things influence your ability credit influences your ability to get the best circumstances. So there are three major credit bureaus that most people are familiar with: Experian, Equifax, and TransUnion, but there are actually dozens of other smaller ones. And when you go to get a loan for a car, you really don't know which one is being used unless you ask, and you can ask. And if you get an adverse answer as far as applying for a loan, you have a right to see a copy of the report that person used. And I can tell you they vary wildly. And people also can use them to manipulate things, so you have to be careful. I had a situation where I was getting a car loan, and they told me my credit was much lower than it was, and they gave me a crazy payment they came up with. And we left there. I asked for a copy of the report. They told me they weren't allowed to give it to them. I explained that they were, and they did. And I saw it was a name that I wasn't familiar with, of a small credit reporting bureau. And then I immediately went to another place and did processed my loan, and it went through easily, and I had a very favorable rate, and there were no issues. So if you're it's really important to know your credit, and we'll talk about getting a copy of your credit and looking at it. These are some of the things on your credit report. I won't go through them in detail, but you know that some of the general demographics would be on it, like your name and birth date and social security number. That's why it's important to keep it confidential. And that's why it's very upsetting when something happens and there's a breach and that information is exposed. Also, public records like bankruptcies, civil judgments, and tax liens are actually, tax liens should not be on your report any longer unless they've gone into a major default, and because that was removed recently. But bankruptcies and civil judgments will be. And then collections are on your credit report as well as your good, positive stuff around trade lines. So we're going to talk about, also you have the number of credit inquiries on your credit report, which is surprising to some people. If nothing else surprises you on your credit report, when you look at it, sometimes the number of inquiries that happen do surprise people, because they don't realize that a loan they have out may be checking every 3 months to see what their credit score is, and they don't realize that that's going to take place. All right, so when you're looking at your credit report, it gives some information on each trade line, the balances, the amount owed, and the past due. And of course, past due has a negative impact on your credit. So one of the most important things you can do to keep your credit strong is pay bills on time. Even if you have a credit card that is getting higher than you're comfortable with, if you pay the minimum balance, it will help your score stay high, but it won't diminish the principal very much. So you always want to pay more than that if you can. It does not include payday loans unless they've gone into collections, medical debt unless it's gone into collections for, I think, 6 months, and utility or rent unless they've gone to collections. So hard inquiries, you may hear people talk about it's a hard inquiry, it's a soft inquiry. It's just another way of describing a hard inquiry is when you're getting a loan, and a soft inquiry is not going to affect your score. There are a lot of payday companies do soft inquiries so that it doesn't impact your credit, and then you get the loan and you don't have your credit impacted. But of course, if it goes into default and it goes to collections, then they can report it. So how long does stuff stay on your credit report? Positive information can stay on forever. That's the good news of credit reports. Negative information for a specific period of time, it can vary by state, but typically 7 years or up to 10 years for bankruptcies. Civil judgments and things like back child support can also be on for 7 years or whatever the statute of limitations is for the state where you are located. There is no time limit that can for trade lines or any credit accounts you have that are active or closed, but in a positive status. So the positive stuff stays on for a long time. That's great, but as it gets old, it doesn't have as much impact on your score as a current negative payment. So that's something to keep in mind. Credit scores typically range from 300 to 850. You can go online and do searches of the average credit score in your state. You do not have a single credit score. There are, as I said, multiple credit reporting agencies. Most use the largest percent of lenders use the big three that we talked about, but there are others that use other companies. And then even the big three have multiple versions of their score. When they change an algorithm or tweak it, they also have different scores depending on whether it's a mortgage or an auto. Okay, so you understand about scores, you understand the range typically goes from 3 to 850, and this kind of gives you a rating of where you fall. And you can find a lot of this information on the websites as well of the credit bureaus, but also please visit our website because we provide non-biased information that won't be selling anything to you as well. So if your credit report accurately shows you missed a few credit card payments, what should you do? It gives you these choices, and I'll tell you the answer is wait it out. You don't want to close the account because that can affect your credit utilization, which is the percentage of credit that you're using, and you usually want that to be below a third. And then filing a dispute, often disputes, they'll take it off immediately while they research it, and then it may go back up, or it'll just say in dispute on your credit report, and that's starting to impact the credit a little bit negatively too, it looks like. So filing a dispute is something you have a right to do. We have sample letters on how to do that on our webpage, but it's something that you should only do if you really think it's in dispute. And the correct credit repair services, there are some good ones, but a lot of them are not, they go and they just file a lot of disputes, and because they'll automatically take those off until they investigate, your credit will bump up for a short term, but then it will fall again later when they correct it. This is basically from the FICO page, and it is a showing of what things impact your credit the most. And as I said, payment history, 35% is the most. Are you paying on time? If you pay whatever you can on time, that covers your minimum balance, that will make a huge difference in your credit. The amounts owed do make a difference, particularly when it's relationship to the credit you have. So if you only have one small credit card of 500 and it's to the limit, I'm not advocating that you go out and get new credit. You'd have to look at it and talk to a credit counselor, and some of you may be that, and you can do that. But it might help you to actually add a credit card with another balance so it goes up. But that's not a good reason to add it. It should be something that's manageable that you need. And then the length of the history. If you have old trade lines you've had for a long time, paid them on time, that's worth more than new ones. The types of credit, retail credit, as I mentioned, typically hurts more than other types of major credit cards because they're higher interest rates and they're easier to get. And then how many credit inquiries you have. And when you apply for a lot of credit, within a short period of time, it can, outside of over time, it can impact your credit. So for those that want to build credit, student loans for new students do impact your credit, and you begin repayment 6 months after leaving, and they become a part of your credit history. Credit card authorizations, if you're an authorized user, if you don't have a card or someone you're helping build credit doesn't have one, that can help. It can also hurt because they have less control, and if the person that they're authorized with does not do well, it doesn't work very well. I actually had, my credit was being negatively impacted by being an authorized user just because the credit limit was high. And I called and asked them to remove that, and they did remove it immediately. Somebody had told me to do that, and they said if they push back, just repeat, I want it removed. And so I called, and they did push back and say, well, you're an authorized user. And I said, yes, I am, but I don't want that on my report. It's not, that's not my card. And they took it off, and it made a difference. We talked about rent payments, and that if you have a client that has rent and they're not reporting, they might want to talk to their landlord to see if they're willing to do that. And then there's credit builder loans where you work with banks or credit unions. I know Credit Builders Alliance is another group that has it. Some of you may be aware of others, but they basically put in $300 to $1,000 in a locked savings account, and you pay it back over a certain time. You get that loan you pay back over time, and if you pay it on time, then you actually will build your credit. And there's some credit. I know Capital One has some credit builder loans, and some other major banks have it. They don't push it because it's not something, I don't think that makes them a lot of money. But if you have a child that you want to help build credit, you can go to other major banks and ask, do you have this? And a lot of times they'll say yes. Put $300 in their bank account. You can have a $300 credit card. If they use it wisely, it'll build their credit. So I'll let you read through this slide when you see it. It gives you some ideas about what to look for when you're trying to get a credit card. You want low interest rate, of course, but some people like rewards if you use it well. And some people, if you're going to use it heavily, then the interest rate's the most important thing. If you're only going to use it when you want to, just to keep your credit high, you might go for something with rewards. Okay, so when you're talking about protecting your credit, if somebody opens your credit an account fraudulently, you do go to identitytheft.gov. I won't go into a lot of detail because this could be another session, but we do have an upcoming session on identity theft at the CFPB on the 16th of this month. So you're welcome to join that if you'd like. But this gives you the general idea, and I think Linda also covered well about getting fraud alerts. And you can also freeze the credit for anyone by contacting the credit bureaus and saying, just freeze my credit. I don't want anybody to be able to access it. And a lot of people do that for their children because they shouldn't be having loans, and they don't want people do tend to go after younger, when they're doing identity theft, younger accounts, because they know they may not have been impacted. Okay, so incorrect records can hurt your credit. That's why you want to know your credit report. You want to go to annualcreditreport.com, download a copy. During the pandemic, you can download a copy weekly, and that keeps being extended for how long? I didn't check recently the site, but I would take advantage of that. I'm trying to check mine more often. I said I would do it weekly when they allowed us to do that, and I have not done it weekly because it does take some time, but it's free. You go to annualcreditreport.com, you answer a few questions, and then you can get a copy of it. So we have a checklist at the CFPB that you can use to go through and check your credit report, and you just it tells you, is your name correct? Is the social security number correct? It'll walk you through it. And so when you get a copy of these slides, you can visit annualcreditreport.com as it tells you here, and you can use the checklist to make sure your credit's okay. And you can use that every time when you're checking your credit. And you can dispute errors, and we have information on our site of how to dispute. And this link here gives examples of letters that you can use. And I learned yesterday the National Law Center that Chichu is with also has sample dispute letters that you can use. All right, so again, identity theft can hurt your credit. People are doing it a lot during the pandemic, which is why the bureaus are allowing you to, access it. Please do check your credit report at least, monthly, download it, because you're most likely to find an error. It may not be identity theft, but even an error in the name or somebody else's account put on your account can really negatively impact your credit. And sometimes that's the only way you know something's going on. So very important to do. And always keep an eye out for identity theft when you start to get billing reports, if there's anything weird. And if you get bills from people you don't know, don't just throw it away. Please look into it, because it can end up hurting your credit. And also IRS notices. Sometimes if, check things out, the IRS won't call you. You should get something in writing, but if you get something in writing and it's not correct, there is a lot of identity theft around filing taxes. File your taxes early too, because when you file late, that makes you more prone to it. So here is the place that you can report identity theft. It's the FTC, and you can refer to this page. And again, we have a webinar coming up on this on the 16th. So if you join our list, you'll get information on that. And then rebuilding. Would you ever pay someone to repair your credit fast? Most of the time that does not work. You can do what they do, which is basically disputing things on your account. If you're doing it because you just don't have the time and it's worth it to you to pay that and make sure it gets done, but you have to watch them and make sure it's done well, because I've seen some companies that send out very unprofessional letters that I think don't reflect well. And I think that people begin to recognize their letters and they don't, the bureaus don't react to them as much. So I'm not saying there aren't good credit repair companies, but please reach out to some of the nonprofits listed here if you're going to use that. There are also debt settlement companies that will help you come to agreements to pay debt that's less, or help your clients to pay debt less than what they owe if they're not able to pay it. And they will ask a lot of income information. But again, there are some predatory debt settlement companies as well. So make sure that you reach out and look them up in areas, get a reference from somewhere that you trust that's non-biased. All right, it looks like my time is running here. I'm a little bit over. I apologize. And my slides seem to be stuck. So that happened well. I think I'm going to wrap up here, but I will come back and answer any questions you have, and you will have a copy of the slides. I see the chat box may have some things there. So Chi-Chi has told me that almost all civil judgments have been removed from credit reports. So all civil judgments should be removed from credit reports. Thank you, Chi-Chi. And with that, I think I'm going to hand it off, Linda, if that's okay with you. I don't want to take up too much more time here, but I do want to allow people a chance to ask questions at the end as well. So I will hand it off. Linda, should it go back to you? Maybe not.
Hi, this is Nelson. I'm going to give control to Ryan now.
Thank you.
Yeah, I'm on. Thank you. So let's turn it over to Dr. Sandler, so that we can learn a little bit more about credit disputes. Are you there, Dr. Sandler? Let me give you control of the mouse. So you have control. Take it away.
All right. Well, thank you so much for having me. I'm going to be talking today about the results from a report that we put out at the CFPB about a month ago, with the title that you see here, Consumer Credit Trends Report on Disputes on Consumer Credit Reports. If you Google the title, you'll find it on our website. This is part of our longer running series of consumer credit trends reports. We used to call them quarterly consumer credit trends reports, but we stopped putting them out quarterly. And these are bite-sized reports, no more than 10 pages, no more than sort of 5 tables or figures, and usually a fairly approachable way that tell you about one particular aspect of the consumer credit market. And so the particular one from this report is that of disputes that appear on consumer credit reports. All right. So the same disclaimer that Heather made applies to me. Any statements made here that are not within the 4 walls of the report are my views, and which may or may not represent those of the Bureau. So the motivation behind this report, which should come as no surprise from what you've heard presented so far, is that accuracy on credit reports has long been a contentious issue. In particular, since the start of the pandemic, there's been a spike in complaints to the CFPB about credit reporting. This report's getting a little old now, but it's a good one. Back in 2012, the Federal Trade Commission put out a report based on a nationally representative sample of consumers, where they had everybody in their sample check their credit reports and help them dispute anything that appeared to be wrong. And in that report, they found about 25% of consumers had some kind of error on their credit report. And I think about 5% overall had errors that were substantial enough that if they were corrected, they would shift the person's credit score significantly. More recently, there was a report put out by Consumer Reports that did not have a nationally representative sample. It's just they enlisted people who came to consumerreports.com, but also found substantial rates of errors, despite the fact that their sample was overrepresented with people who you would expect to be less likely to have problems with their accounts. So it was higher income, higher educated, and more white than the national population. So what we're trying to answer in this report is two fairly simple questions. Who has evidence of a dispute appear on their credit reports? And what happens to those accounts that are reported as being in dispute? So to give you an idea of what I mean by disputes, though Heather talked about this to some extent. So that the Fair Credit Reporting Act has a specific provision prohibiting furnishers, people who are reporting to the credit bureaus, from reporting an account that is in dispute, unless they also note that the account is in fact disputed. One funny little twist is that same part of the FCRA requires that furnishers report accounts that have been voluntarily closed by the consumer. So the consumer themselves said, yes, close this account, I don't want it anymore. The other thing that the law requires is that if a creditor gets a notice of a dispute from the consumer or from the credit bureau, they have to investigate and then notify the credit bureau of the result of their investigation. Now, one thing worth noting is that exactly how the account is handled while it is in dispute, aside from reporting that it is in dispute, it's actually not spelled out in the law. And Heather mentioned earlier that while things are in dispute, they don't get counted for credit scoring. I thought that was the case. And then when I was writing this report, I ran the report by our staff in our supervision division that supervises both banks and the credit reporting agencies. And it turns out it's actually not clear how the credit reporting agencies handle accounts that are in dispute. So it's merely having something in dispute doesn't necessarily have a direct effect on credit scores, worth knowing. So in order to look at this, we're going to be using data from the CFPB's Consumer Credit Panel, or CCP. And the CCP is a sample of about 5 million de-identified credit records, one of the 3 nationwide consumer reporting agencies. So we don't know anybody's names. We have no personally identifying information. We just have anonymized IDs that allow us to follow people and their accounts over time. The way the data appears to us is that every quarter, around the end of the quarter, we get a snapshot of all the accounts on people's credit record at that time. At the end of March, June, September, December, we see what was going on with all of people's accounts. We get indication of whether there may have been disputes through a field called the Compliance Condition Code, which I'm going to colloquially call the dispute flag. Specifically, I'm going to refer to a dispute flag as a value of that compliance condition code relating to disputes, because that same field is also used to indicate accounts that consumers have asked to be closed. It has nothing to do with disputes. It is just the credit bureaus use that field in order to comply with the FCRA, and so because they're complying with both those provisions, they're both in the same space. Now, all I see about the dispute flag is the fact that there is one. There's a value for in dispute, there's a value for it used to be disputed, and there's a value for the consumer disputed and the consumer disagrees with the outcome, meaning probably that the investigation did not turn up that the information was inaccurate, but the consumer still says it's inaccurate. That's all we get. We know that one of those 3 things happened and that there was a dispute. What the dispute was about, and also exactly when the dispute occurred, we don't know that. So the results I'm going to show you are limited in that way. The other limitation of our CCP in general is that we don't observe a lot of demographics on the consumers themselves. We know where they live broadly. We have the census tract where they live from the credit bureau. We have their age, because birth year is one of the things that is reported to credit bureaus. But that's about it. We know their age, we know their credit score, we know where they live, and so we can characterize people based on the neighborhoods that they live in by matching the census tract with data from the Census Bureau on demographic characteristics. So specifically, I'm going to look at just 4 types of credit and the dispute flags that appear on those types of credit. These are auto loans, student loans, general purpose credit cards, and retail credit cards. And those are chosen because among credit accounts, those are the types that have the largest rates of disputes. Now, I've put on the slide the percent of accounts that at some point had a dispute flag during the sample. And I should note this isn't directly comparable to dispute rates found in other studies. So I said at the top that the FTC found 25% of consumers had an error on their accounts. For a lot of reasons I don't have time to go into right now, that's apples and oranges. So you can't compare those directly. It is not the case that we're finding a lot fewer disputes now than the FTC found in 2012. Just state that outright. I'm going to focus on accounts that were open between January 2012 and December 2019. And the idea here is to focus on, well, first of all, the period where we see the compliance condition code, that dispute flag variable. We don't have that from the credit bureau before 2012. We don't have that data, we can't work with it. And to make sure that we understand exactly what's happening with these dispute flags, I want to make sure I observe the entire history of any disputes on the account. So because the accounts weren't even open before January 2012, I'm going to observe all the dispute flags that occur on them. And I'm cutting it off at January 2019 because we want to see sort of the usual behavior of disputes and not what's been going on during COVID, which can have been strange for all sorts of reasons. Before I get into the results, I do want to point out one other key limitation of these results. Dispute flags, the values of this compliance condition code that I see in the data, is not the same as disputes and is not the same as errors. And what I mean by that is that a consumer can have an error on their account that they don't end up disputing, either because they don't know about it or they don't think it's worth disputing it, or something else gets in the way. It is possible for a dispute to happen about an account that is not actually an error. When Heather was talking about sort of fly-by-night or dishonest credit repair companies that just dispute everything on a credit report, to the extent that that occurs, like those dispute flags don't actually reflect errors on the credit report. They reflect an attempt to sort of muddy the waters to improve someone's credit. It is also important to note that furnishers, creditors are only required to report the existence of a dispute while that dispute is being investigated. If they resolve the dispute, particularly if they resolve the dispute in the consumer's favor, and they do it quickly, I may not see the dispute. Particularly because the data that I'm using here is quarterly. So if a consumer disputes some information in April, and then the creditor investigates and they say, yes, you're right, this thing is wrong, and they fix whatever was wrong, then the dispute could be removed in May, and then when I see that record next in June, it's gone. So I've just missed the existence of that dispute. It also could miss disputes where the resolution is to delete the account. So I would not see that I would see that the account disappeared, but I wouldn't know that it was because of a dispute. And so although the results I'm going to show you are representative of what accounts and consumers with dispute flags look like, the population of all people with disputes or people with errors on their accounts may be different. So with those caveats, let me tell you what I found. So the first thing we looked at was the distribution of ages among people who dispute. So my expectation here is that we would find more that disputers, people who dispute flags on their credit reports, would be older on average because they had more experience with the credit system. The more experience you have with the credit system, the more likely you are to know that you can dispute and you would actually do that. That actually doesn't appear to be true. So for instance, among people who have dispute flags on auto loans in the top left subgraph, 26% were 18 to 29 and 41% were ages 30 to 44 when the account that is disputed was opened, compared to 21 and 30% of people who never disputed during the sample period. So for most types of credit, the people who disputed were younger on average than people who did not dispute any accounts. The exception is student loans, and I think that's partly driven by the fact that there's less reason to dispute a student loan when you are young, in that 18 to 29 bin, because there's very little point in disputing an account before you're actually paying it. Most student loans, you don't have to start paying them until you leave school. And so many people with student loans in that 18 to 29 bin, they haven't even started paying them. And so it's not surprising that they haven't gone and checked and disputed potentially inaccurate information. The other thing we looked at is the distribution of credit scores. And this is using the credit score, again, as of the time the account was opened. So whatever negative information might have been disputed and whatever the result of the dispute was, that's not affecting people's credit scores for purposes of categorizing them here. And I think it's really interesting and notable that people with low credit scores, or that disputers are much more likely to have a low credit score well before they even had to dispute the account. So for auto loans and student loans, it's particularly notable. About 3 times, disputers were 3 times as likely to be in the deep subprime credit score bin. Student loans more than twice as likely. About half of student loan disputers were in the deep subprime bin. So in fact, disputers tended to be lower credit score. Finally, and this is the result that Linda highlighted at the top, looking at the share of accounts that were disputed based on the census tract race and ethnicity makeup. So again, I don't observe the race and ethnicity of the actual individual consumers. That's just not in the data. But I do observe the census tract where they live. I can categorize the census tracts based on data from the American Community Survey into tracts that are majority white, majority black, majority Hispanic, and majority Asian. And I find that although the percent of accounts that had dispute flags in majority white census tracts pretty much reflects the overall percentages that I showed earlier, consumers residing in majority black census tracts were 2 to 3 times more likely to have a dispute flag appear on their accounts that were opened between 2012 and 2019. Now, one thing that's only discussed very briefly in a footnote of the report, one thing you might be concerned about is we know, for better or worse, honestly, mostly for worse, that credit score is correlated with race and certainly is correlated with census tract race and ethnicity. Meaning that on average, you would expect people in majority black census tracts to have lower credit scores. And we know from the previous slide that lower credit score is also associated with having more disputes. And so one analysis that we ran in the background, it's not reported in the report, except in the footnote that I mentioned, it is a statistical analysis called a regression analysis that controls for other factors. And so holding constant census tract income, holding constant credit score, holding constant age, we actually still see a differential in the rates of disputes between majority white, majority black census tracts. So it's not just that those are correlated with credit score and other things. There does seem to be something there. I still would not go so far as to say that it's causal, that because you are black or because you are living in a majority black census tract, that's why there are more disputes. But it is a little more robust than that. Actually, the difference between majority white, majority Hispanic census tract does mostly go away if you control for credit score. So one final result, looking at what happens to trade lines accounts after they are disputed. So looking at 4 particular endpoints, one is the dispute code is removed. So you had a dispute code, now you don't have it anymore, which could be that something was changed and they fixed something, but they didn't remove the account, or it could be that they said, no, your dispute is not valid. The account could be deleted with the dispute code still on it. The account could be closed, or the account could be still on the person's credit report, but hasn't been updated in a long time. And interestingly, we find very different rates of these outcomes for different types of credit. Credit cards, general purpose credit cards, are very likely to see dispute codes removed, which may reflect that those accounts, when they are disputed, it's about a charge on the account rather than the validity of the account overall. Student loans are very likely to be deleted. I should note this is partly due to the fact that student loans just have a habit of disappearing. I try my best to account for this in the data, but the reporting of student loans by student loan servicers is less reliable than one might like. But still, we do see more of that for disputed accounts than for not disputed accounts. Auto loans are often closed, partly that the term of auto loans is much shorter than some of these other accounts. And retail cards are the most likely to have the account just stop updating entirely. So just to quickly wrap up, so we find that disputers tend to be more likely to be young, more likely to be low credit score, more likely to reside in majority black and Hispanic census tracts. And the outcomes for disputed accounts vary across credit types. Now, the big unanswered question, though, is why? Is this about who has errors on their accounts, about who takes action to dispute the errors, about whose disputes actually show up on their credit reports as dispute flags? Or is this about the furniture side? And it's about how different furnishers and different industries report that information. This is something that will have to be explored in future research, and something we're going to be continuing to look at the CFPB. So thank you again for having me out, and I'd be very happy to answer questions at the end. Turn it over to TC for the next presentation.
Thank you, Dr. Sandler. Thank you so very much for that presentation. Let me see if I can get the mouse over to turn the presentation over to Ms. Wu. Having a little problem. Okay, I don't know about you, but I'm really interested in learning more about her testimony before Congress and the overhaul of the credit reporting agency. Chi, you want to see if you have control?
Hi, Linda. Yeah, let me see if I.
Okay, here you go.
Oh, maybe.
Here you go. You have control.
All right. So thank you, Linda, for turning control of the mouse over to me. And thank you for having me on this webinar. Really appreciate it. This is I think the third time I've spoken at one of your events, and I'm always pleased to do so. Consumer Action and National Consumer Law Center have worked together for a long time on a lot of different issues, and we are strong allies, and it's always a pleasure. I should let folks on the webinar know that I did get kicked off the webinar earlier, and something is going on in the ether because we're running our own conference at the same time, and our entire platform crashed. So I'm going to chalk it up to the entire internet being wonky today. I missed some of the other presentations, so if I repeat something or I missed something in an earlier speaker, Ryan or Heather said, I apologize in advance. So Ryan Sandler earlier talked about disputes on credit reports and the dispute rates. One of the things I don't know if you had a chance to mention was that the CFPB itself receives complaints about credit reports and credit reporting issues. And last year, the CFPB received about 300,000 complaints, and that was twice as much as the year before. So that's a lot of complaints, and it doesn't surprise me because over the years, we've documented a lot of problems with the credit bureaus and the credit reporting system. And fundamentally, they stem from the same sort of origin, which is that, and you might have heard this before, with credit bureaus, consumers are not the customers. We're the commodity. Our information is the commodity. These are three corporations, so it's basically an oligopoly, to use a big word. But it's more than that because you don't have any choice between the three of them. You can't say, I hate Experian, I will only deal with TransUnion. You have to deal with all three if you want credit. If you're trying to get an apartment, if you in some cases, trying to get a job. And yet these three companies who basically hold our financial report cards, they are not only private, they're publicly traded, which means their highest duty isn't to consumers, it isn't even to their customers who are creditors or debt collectors, it is to shareholders, it is to make money. Now the customers are creditors and debt collectors, and so the incentives they have for certain things is to appease their customers, not consumers, and that results in a lot of problems. It results in a lot of inaccuracies. I believe Ryan Sandler talked about the FTC study, which found that 1 in 5 consumers has a verified error in the credit report and 1 in 20 has a serious error. That's millions of people who have an error in their credit report. So the question really shouldn't be why there's so many complaints or so many disputes on credit reports. It's how come there aren't more? And some of the just to give you an example of some of the procedures that the credit bureaus implement to favor creditors and debt collectors, and which ends up hurting consumers, is the problem of mixed files. So one of the most important tasks for a credit bureau or for any consumer reporting agency or big database is to figure out what information belongs to what consumer. This is called matching. And in order to match, you have to use certain matching criteria. Now, the CFPB, and this is such an important task, the CFPB just put out an advisory opinion about it, telling certain types of consumer reporting agencies, like tenant screening agencies, that they shouldn't match based on name only, for example. With credit bureaus, they should have an easier job because they have the piece of information, unlike tenant screeners, they have a piece of information that's unique to each American, which is the Social Security number. The problem is that the credit bureaus match information based on a partial match of the Social Security number, based on 7 out of 9 digits, and based on partial name, partial address. And so this can sometimes result in what's called a mixed file, where the information about 2 different consumers gets mixed up. And it's incredibly frustrating and difficult for the consumer who might have a good credit record if they're mixed with somebody who has a bad credit record. We've literally seen legal judgments against the credit bureaus for doing this that have resulted in legal judgments in tens of millions because it's been so intractable. And this is just one example of the types of policies and procedures that the credit bureaus engage in that favor their customers, creditors and debt collectors, and not consumers. The other problem with credit bureaus that really harms consumers is the whole dispute system. So you heard a little bit about how the dispute system is supposed to work. Now let me tell you about the reality. The reality is that a consumer might submit a really well-documented dispute, a really strong dispute to a credit bureau with like a long letter explaining what happened, maybe some documentation, maybe even a court judgment saying they don't owe a debt. And what the credit bureau will do is they'll upload the information, send it to the entity that furnished the information, the creditor, the debt collector, which we call the furnisher. And that furnisher, whatever that furnisher responds, the credit bureaus will accept. It's like a judge who always rules for the defendant. This is a problem we've been documenting for decades. I wrote a report about it in 2009. In 2019, I wrote a second report. During that period of time, there were a number of reforms that improved the situation somewhat, but still this fundamental issue of what we call parroting, basically always deferring to the furnisher, still exists. And so that's why if you've ever tried to help consumers with a credit reporting dispute and you find you can't get the information off, even if you have something like a court judgment saying they don't owe the debt, or a bank statement showing that the payment wasn't made late, the information still stays on. So, I could go on about the problems with the credit reporting system. There's a host of other problems, including the fact that all of these problems with the credit bureaus have also resulted in a market opportunity for them, where they literally sell our own information back to us in the form of credit monitoring for like $20 a month. Now, in addition to the outright abuses by the credit bureaus, you have systemic issues. Okay, did I just lose control of, oh, here we go. Systemic issues with credit reports. So as Ryan Sandler hinted to in his talked a little bit in his presentation, there are huge and significant racial disparities in credit reporting and credit scoring. About 5 years ago, I did a policy brief that is linked to in my PowerPoint called Past Imperfect that just listed a whole bunch of these studies showing really striking racial disparities in credit scores between Black and brown consumers and white consumers. Since then, there have been more studies. One of them, for example, by the Urban Institute, found that over 50% of white households have FICO scores above 700, compared to only about 20% of Black households. And this is data from Freddie Mac. So this is individual households. There are also disparities by income as well, although they are not as stark as the racial disparities. Heather Brown talked earlier about all the different uses of credit scores and credit reports, not just by creditors. We actually think that's very problematic. We think that credit scores shouldn't be used for other purposes. They weren't really designed for some of these other purposes, or they have nothing to do with other purposes like insurance. What does your credit history have to do with how good of a driver you are? Employment. Now, employers don't use credit scores, they use credit reports, but still, we don't think that your credit history has anything to do with how good of a worker you are. And the idea that credit scores and reports somehow measure responsibility or diligence as a person, I think is refuted by the entire experience of the pandemic, where we saw people who suffered economically and had their credit histories impaired, not because they were sloppy or irresponsible, but because they lost their jobs or had their hours cut through circumstance. They were in an industry that was hard hit, like hospitality. They got COVID, a family member got COVID. That has nothing to do with your character. Tenant screening. Credit scores are used in tenant screenings, and it's having a terrible impact, not only on low and moderate income consumers, but Black and brown consumers. There's an article from the New York Times Magazine in May of this year, which talks about how thousands of low moderate income Americans can't get decent housing, a decent roof over their head, and they're consigned to these extended stay motels, which are suboptimal because of low credit scores. So you have a whole sector of folks being shut out from just having a decent roof over their head by credit reporting, credit screening, credit scoring. And then the Trump administration tried to use credit scores and credit reports for immigration purposes. And just today, I saw a report on Twitter that some folks did a research study claiming that credit scores were good screening tools to determine which medical students should get into residencies for surgical residencies. And my reaction was, what the heck? We already know there's a huge problem with disparities in terms of healthcare and not having enough Black and Latinx doctors to serve those communities. And you want to exclude more Black med students, for example, from surgical residencies by using credit scores? That's a terrible idea. Credit scores really fundamentally reinforce inequality, because a lot of impairment in credit history has to do with where you come from and what your socioeconomic background is, and nothing to do with really your behavior or responsibility. And I should have concluded one more bullet here about systemic issues with credit reports, and this goes to the issue of buy now, pay later, which was a question asked. I was asked to talk a little bit about, and I don't have a whole lot to say about it because it's a new industry and there's not much of a track record. What we do know is that, first of all, there's a lot of buy now, pay later lenders who aren't even reporting to the credit bureaus. And even if they are, we're not sure how helpful it is. And that is due to some of the credit scoring factors that Heather Brown went through earlier. Because buy now, pay later, for example, it's often reported as closed-end credit with a very short term. And length of credit history is one of those things that gets measured in a credit report, in a credit score. And the longer the credit history and the older the accounts, the better for the score. Another huge factor is that credit utilization factor, that comparison of how high a credit limit and how much credit has been used of that limit. And you can tell that utilization factor is heavily impacted by credit cards. So if you have buy now, pay later, which is closed end, sort of like an auto loan or a mortgage, you're talking about a very short-term closed end credit of just a few months, and that's going to look like high utilization and very young credit, and that's not going to be great for a credit score. Even though you would think if someone purchased something using buy now, pay later and paid it off, that would be a good indication of how good a borrower they are. But sort of the wonkiness and rigidity of the system, and maybe the scoring algorithms will be revised and evolve, and later versions will, treat buy now, pay later better. But the problem is that those new algorithms are going to take a very long time to be adopted. Right now, FICO itself has FICO 10, yet most credit card lenders are using FICO 8, and mortgage lenders are still on classic FICO, which was developed, 15 or more years ago. So with all these problems in the credit reporting and scoring system, what are folks trying to do with this? So there are a lot of proposals to try to reform the credit reporting system so it works better for consumers. The strongest proposal, the most forward-thinking one, is this idea of a public credit registry. It goes back to what I said earlier about the fundamental dysfunction of credit reporting being that you have 3 private for-profit companies running this, where it really should be a function in the public good. So the idea would be to place credit reporting in a public agency, and the specific proposal is to put it in the CFPB. We have supported this proposal at NCLC, and this group Demos wrote a whole paper about it, and there's a link in this PowerPoint to the paper. And this would mean that the public credit registry would be accountable to voters as opposed to shareholders. It would have a public mission as opposed to a mission to make money, and it would serve the American public and not just creditors and debt collectors. The other proposals to reform the system, the Comprehensive Credit Act, which was introduced by Ayanna Pressley, and is something that actually Maxine Waters has worked on for a number of years. The Protect Your Credit Score Act is a second bill that is in Congress that could create an online portal for all things credit reporting related to make it easier, and would introduce reforms to accuracy of the dispute system. The latter 2 bills have actually been introduced in last Congress. They passed out of the House of Representatives, but unfortunately they went nowhere in the Senate, where they have been the Comprehensive Credit Act has been reintroduced again. And we're keeping our fingers crossed for both these bills. The Public Credit Registry, there hasn't been a bill introduced, there's been a discussion draft circulated. So those are some of the ideas and proposals to fix the broken credit reporting system. And I'm happy at this point to take questions on any of this.
Great. Thank you, Chi-Chi. Thank you so very much for that presentation. And please join me in thanking all of our speakers for such great information. Now, audience, we get to hear from you. Nelson, do we have any questions for our fantastic speakers?
Yes, we do have questions. Can you hear me okay?
Hear you just fine. Go ahead.
Great. So Heather, maybe this one's for you. You told us earlier that positive information stays on indefinitely, negative information stays on for 7 years. Somebody's asking that they're noticing that federal student loans appear to stay on credit reports longer than 7 years. Is this true? And how long do federally backed student loans, or how long are they supposed to stay on your credit report?
I'm not an expert in the student loan section because that's another group. So I imagine that may vary. I thought around 7 years was correct, but what I'd like to do is ask you to please send an email to me unless Chi-Chi knows the answer to that, I'm happy to have her chime in. But if not, if you could send an email, you have the answer for Chi-Chi?
Well, I have a partial answer, which it just depends on the kind of loan. The Higher Education Act does have special time limits for information for certain types of loans and not others. It just depends on the type. And I don't have at my fingertips the exact, like what type of loan has a longer limit than 7 years. Some of them do allow reporting 7 years from when the loan was repaid, even if there's negative information. So the general rule is that the 7-year limit is for negative information. So if the entire account is positive, it can stay on forever. What I've seen from industry is that they tend to drop off positive information, or positive accounts tend to drop off after 10 years after the account is closed.
Thank you for helping me out there. And I also wanted to let you know, you can send an email to cfpb_finex@cfpb.gov if you have a specific question about it, and I'll refer you to our group for student loans. And I also think that the National Consumer Law Center has a guide that talks about student loans and how to try to get some off if you had a school that closed. And I'm planning to get that. I learned that yesterday, so that might be another resource.
Yeah, we have a whole website, the Student Borrower Assistance Project website, that talks about things like closed school discharges and disability discharges. We also have legal manuals on both fair credit reporting and student loan law. We have a ton of resources. And folks should feel free to email me directly, cwu@nclc.org, and I'll put that in the chat.
Thank you, Chi-Chi. A couple more questions. I'll ask them both. Are small questions regarding information that's on the report and how long. Someone's asking, where can they find more information about that talks about how positive information will stay on the credit report indefinitely? And then also someone was asking, is it true that judgments are no longer being reported on credit reports?
So I can take the second question. Yeah, the vast majority of judgments are no longer being reported on credit reports, and that is the result of both the good work of the CFPB and their supervision, as well as a settlement between 31 attorneys general and the credit bureaus back in, I think, 2015, 2016, which the credit bureaus have rebranded as the National Consumer Assistance Project. Now, this is just credit reports. Eviction records, for example, still show up on tenant screening reports, which are a different type of specialty report.
And I'm not sure I understood the first question. I thought they were asking something about where they can get more information on why good things stay on the record. Is that what the question was?
The question is simply, yeah, and thank you, Chichi, for that first answer. Where can they find more information that says, I guess maybe they're asking where in the rule or where in the law that says positive information stays on the credit report indefinitely?
Yeah, I'm not sure about that answer either. So please feel free to shoot an email. I'll put the email in the chat again, and I'll try to look into that for you.
Great, thank you. And then we
do you want me to take us?
Oh, what was that?
Do you want me to take a stab at it or move on to the next question?
Oh no, go ahead, Chichi.
Yeah, so the way the Fair Credit Reporting Act works is it has a bunch of protections. So it has protections for accuracy. Consumer reporting agencies are supposed to have reasonable procedures for maximum possible accuracy. It has prohibitions against certain types of information, the major one being older information, that 7-year and 10-year rule, also certain types of medical information. But beyond that, there aren't really restrictions. Like there's no rules about how long positive information can stay on, what kind of information can be in a consumer report. I mean, literally, you could have consumer reports about things like, I don't know, shoe size or astrological sign. I mean, you don't have that because that's not very useful, but there's nothing really prohibiting it.
Great, thank you, Chichi. We do have a comment, and it says, in its role as a federal regulator, the CFPB has been effective in addressing systemic discrimination on the basis of race, gender, age, and other protected factors. They're saying when you give a public presentation about how credit works, they think that the CFPB should acknowledge that the system is systemically inequitable. It says we shouldn't pretend that the system is objectively reasonable. Any comments on that?
Well, this is me, Heather, speaking personally. I agree with that statement. But we also have to strike a balance. As a public institution, we have to protect a lot of different sides. But I agree with, pretty much everything Chi-Chi said and what you're saying, Heather, personally. But I can't always speak on what my opinion is on things when I'm presenting. But I understand what you're saying, and I think it's an important point that you made.
Great, thank you, Heather. Another question here is, what is the impact of self-reporting to credit reporting agencies? This person says that she has some clients that self-report on TransUnion, rent, utility payments, and even insurance payments. What is the impact?
I think she's talking about things like Experian, Boost, and other things like that. You have an option to boost your credit score by giving more information up, and you can get a bump in your score. I just caution people to really get a good understanding of what they're giving up, if they're, if it's really needed. I know people that have done that because they were trying to buy a home and they had to get over a certain hump to do it. And in that case, if that's standing between you and a house, I certainly can see it. On another case, if you have a pretty strong credit anyway, and you're being able to get the loans at the rates that you'd like, you probably want to guard your information as much as possible, because that's more that you'll have to check on when you go and look at the report. So that's my opinion on that. Sounds like somebody else was getting ready to weigh in.
Oh, yeah, I was going to weigh in. That's a great point about Boost, if that's what's being referred to. Basically, with Experian Boost, you open up your bank account transaction information to Experian for them to be to actually a third-party intermediary called the data aggregator. In this case, it's a company called Finicity. You open it up, and they scour your bank account for certain types of transactions. It's not so much rent. I think they are able to tag things like cell phone and cable payments, Netflix subscriptions. The bump is limited. Some folks I know have been disappointed by the amount their score has been influenced, if at all. The other types of self-reporting that are possible is, there are some companies where renters can pay to have their rent payments reported. Sometimes that's useful, but again, the impact might be limited. I personally have very mixed feelings about this whole issue of what they call alternative data, or actually what the CFPB calls alternative data, which is literally defined as anything usually outside the normal credit reporting system, like rent, telecommunications payment, bank account cash flow, and utility payments. It really depends on what kind of data, how it's collected, how it's used. Our fundamental rule or principle is that always should be optional on the part of the consumer. We want to give consumers more control over their data, not less. It's already problematic that we don't have the control over what goes into credit reports. Some of this data, if it's not optional, could actually hurt, like utility data. There's all sorts of problems on a systemic level with the idea of reporting that. Rent payments we thought were promising and wouldn't pose a big risk. And then the pandemic happened and you have 8 to 10 million households behind on rent. And we want to make sure they don't get harmed. So we have, as I said, mixed feelings about it.
Great, thank you. Somebody is asking, do you know what the Congress or Senate's hesitation is to approving the acts that you mentioned, Chi-Chi?
So the House has passed them before, and I think we're hoping they will pass them this Congress again. And to the extent it doesn't happen, it's probably more to do with bandwidth or ability to get on the agenda. There's so much going on in Congress. In the previous Congress, the Senate, I'm going to be blunt here, the Senate was held by Republicans, and that's where consumer protection went to die. Consumer protection bills, that is, went to die. You know, it's better situation now, but you know, you still have the filibuster, and you have the same issue where there's everybody, the Congress overall has a lot on its plate. So I'm still hopeful that this legislation will go somewhere, but you know, it's sort of guarded optimism.
Great, thank you, Chichi. Somebody's asking here, can a negative account be relisted on a credit report after the 7-year cycle ends?
It shouldn't, but that has happened. Sometimes there's been some problems in the past. I haven't seen as many complaints recently, but maybe 4 or 5 years back, where people would dispute something, go through the process, it would be removed, and then all of a sudden it would come back up again. And I actually personally had that happen with my husband's report. Had the wrong name, had his father's name and birth date, they have a close name, and we got it off, and then a year later we looked and it was back, and so we had to go through the process again. So it does happen, but it shouldn't happen.
Thank you, Heather.
Yeah. So that phenomenon definitely we've seen. There's even a name for it. It's called reinsertion, and there's some legal provisions in the FCRA about it. There's another issue. So I wasn't quite sure whether the question was referring to reinsertion or just what's called re-aging debts, especially if with debt collectors, as debts are often sold from one debt buyer to another, if they pop up again after the 7 years. That does happen. It has to do with fiddling around with the date field in the credit report where the 7 years clock starts running. It's called the date of delinquency, and if that gets messed with or doesn't get reported, that can happen. And it is a legal violation in my view, and because that date of delinquency is supposed to be fixed and firm.
Thank you, Chichi. Somebody's asking, how does credit reporting work for non-citizens using lawful unique identifiers that are not social security numbers, such as ITIN numbers and work authorization numbers?
So credit reporting and ITINs has been sort of a complicated, opaque subject. At one point, many years ago, the credit bureaus were willing to say, yeah, you can build a credit record using an ITIN. And for folks who don't know what an ITIN is, it's an individual tax ID number that you get from the IRS, not from the Social Security Administration, and it's supposed to be used for tax reporting purposes. That language was removed from the credit bureau's website, and like from what we've heard, building a credit record using an ITIN is still possible. It's just there's not a lot of information out there about it. For a while, folks with ITINs were having trouble getting their credit reports from the credit bureaus. I don't know if that's gotten any better.
Thank you, Chichi. This question may be for Ryan. It says, when he said that the disputed narrative code is removed, is that because the dispute is resolved or the credit reporting agency just stopped work on the dispute?
Well, the short answer is, of course, we don't know. All we can tell in the data is that there was a code, and now there's not a code. It shouldn't be that they just stopped working on it. As long as the investigation is not complete, the furnisher is supposed to keep telling the credit bureau that there is a dispute. That's what the FCRA requires. Now, are they doing it all the time? Are they doing it consistently? It's impossible to know. I think that's about as much as I can say on that.
Perfect.
So
go ahead.
Just to let folks know, there are different codes for disputes using what's called the Metro 2 system, which is the standardized reporting format for furnishing. So some of the dispute codes will be like, dispute under the Fair Credit Billing Act dispute under the Fair Credit Reporting Act. Dispute resolved, consumer disagrees. Some of those codes will result in the account not being scored for credit reporting purposes. Some of those codes will allow the account to be scored. And one of the reasons having a dispute code can be harmful isn't so much scoring, it's that Fannie Mae and Freddie Mac, when a consumer goes to apply for a mortgage that's backed by those entities, their guidelines provide that if there are disputes on a credit report, the application gets sent to manual underwriting, which is like the kiss of death for a mortgage application. And we actually think that's really problematic, the Fannie Mae and Freddie Mac policies, and we think it's a violation of federal law, but that's a whole other story.
I certainly won't comment on that, but yes, that's right. And then the codes we see are those Metro 2 codes that take those values. There's not many, there's maybe only like 1 or 2 other values besides the 3 or 4 that Cici mentioned. So there's not a lot of detail there. The outcome that I was referring to as code removed is literally there is no code anymore. So presumably, like you would assume that ought to only happen if the dispute was resolved and everybody agrees. Whether that's actually the case is anyone's guess.
Great, thank you. And I don't know if anyone can answer this, or maybe you have a resource to recommend. Somebody's asking, if a credit is in collections, what is a reasonable proposal percentage to pay it off? Where do you get more information on that? You're in collections, what would be a good percentage to offer to pay that off?
So I'm gonna guess the CFPB folks might not want to answer that. I'm actually not sure the answer either, but it sounds like it's some sort of negotiation going on with respect to a debt collection item on a credit report and how much to pay the debt collector. You know, debt collection is not my specialty. I will say one thing though is remember that if a consumer pays off a debt collection item, it does not come off the credit report. It shows as a paid collection item. It stays on the credit report unless the consumer is able to reach an agreement with the debt collector to delete that trade line. And you want that in writing. You want an agreement that if I pay this account, or they call them trade lines, this trade line is deleted. Because a paid collection can still hurt a consumer. The newer scoring models like FICO 9 do not consider paid collections in the scoring model. But as I said, a lot of creditors using FICO 8 or classic FICO. And so that paid collection will hurt in those circumstances. And for employment, employers see the whole credit report and they may or may not view a collection item negatively, even if it's paid.
Great, thank you. Somebody's asking here, can lenders assess creditworthiness using a consumer reporting agency other than the 3 major bureaus, like Innovis or LexisNexis?
Yes, they can, and many do. And there's been a trend toward using consumer reports, which is great to have alternatives, but I thought, I looked at some of the things that were on some consumer reports about me, and it was quite shocking, some of the things that come up. So that's another whole area that needs to be looked at. But yes, in some of those, some of those providers like LexisNexis claim their consumer reports and some of the tools they have are a better measure of whether someone will repay for the particular area they put it out. It might be for mortgages, it might be for auto loans or other things. So that's a whole nother area that's challenging, and people will compile things from public information that may not always be accurate. And so really people should also check their consumer reports from some of those major consumer reporting agencies and companies that also do that as well, because that can be problematic too.
Great, thank you. And we have another question.
Yeah,
Oh, go ahead, Chichi, sorry.
Oh, sorry. Just to add to what Heather Brown has just said, it may depend on the type of lender. So mortgage lenders who are having their loans backed by Fannie Mae and Freddie Mac will have to use Equifax, Experian, and TransUnion reports. But a fintech non-bank lender can use anything they want. to judge creditworthiness. Some lenders who are banks, it might be up to their bank regulator whether their use of different data sources is safe and sound and predictive and such. Since I'm a consumer advocate, I can be blunter than Heather Brown. LexisNexis is a hot mess. Okay, as bad as the three credit bureaus are, LexisNexis. Remember those judgments that came off of credit reports, and they came off because of these matching issues I'm talking about, because public records don't have social security numbers, they often don't have date of births. How do you make sure the correct David Smith on this judgment is the same David Smith you're sticking into their file at a consumer reporting agency? Well, all those public judgments that aren't on credit reports, LexisNexis was the vendor for those judgments, and now LexisNexis is selling them directly to lenders. And I think it's a red flag as a consumer advocate.
Great, thank you, Chichi. And Ryan, we did have a question here for you. Somebody's asking, do you think that possibly the time period of the study shows a parallel time period where low-income consumers, Black and brown, did more disputing due to counseling agencies rising in the community, taking credit classes, etc.?
Trying to think if we did not include in the report any trends over time. I'm trying to remember if I did anything that didn't make it into the report. I mean, certainly we don't get very far into the mechanisms behind this in the report, and that's sort of one of the directions for future work. It's certainly possible that there's something specific to that time period. Although given other work that's found, I think the FTC report from 2012 found that there were more, to the extent that they were able to break things up by demographics, they found that there were more errors for lower credit score and minority borrowers, I think. I'm now not 100% recalling that, so don't quote me on that one. But yeah, I guess the answer in the end is maybe.
Okay, great. Couple of people are asking, I think, Chichi, you told people how to reach you. What's the best way to reach you, Ryan and Heather, for folks that are still asking?
I put my email into the chat and also the email for the FinX program. You can email either, and I'll put it back in again. And you can certainly, Ryan, if you want to email me something to Ryan, then I can just forward it to him. He works more in research, so he doesn't usually interact with the public. He may not want to put his email up for that, but part of my job is outreach, so it's up to, I can refer to him if we need to.
Okay, great. Thank you. And then in the interest of time, I'll turn it back over to Linda. If people have remaining questions, or if we didn't get to your question, go ahead and send it back in and we can try to get it to our speakers, or you can get it to them directly. Thank you.
Thank you, Nelson. Just really quickly, I did get one question in, and it was a follow-up to the judgment question. If judgments can no longer be reported on credit reports, are they barred from other consumer reports like background reports?
So that's a great question. It's a complicated question, and it has to do, again, with this matching issue that I mentioned. Whether or not the consumer reporting agencies that is using these public records has sufficient information to make sure they've properly matched the public record to the right consumer. And the reason that the credit bureaus took them off is because of these matching issues. So there is a question about that. The CFPB just issued this great advisory opinion saying basically name only matching, which is just matching records by name, is not reasonable. And you can see why. There's a lot of people with the same name in this country. But also the advisory opinion cautioned against using matching criteria that was not sufficiently tight or rigid, not detailed enough to make sure matching is proper and they've got the right person. We see all matching problems all the time in background check screening, and especially in tenant screening, because eviction records don't even have date of birth. So it's sort of a question that's sort of fluid and in flux right now. You know, it is a huge problem because tenant screening, as you can imagine, is the hot issue actually in consumer reporting now, given all these people who got displaced because of owing back rent during COVID, people who may not even have gotten evicted, but voluntarily moved out early.
Great, thank you. And thank you to all our speakers for hanging in there and answering all of the audience questions. Again, I want to let you know that this webinar was presented as part of Consumer Action's COVID-19 educational project with funding from Chase. Now, if you would like to contribute to Consumer Action, you can do it online by credit card or by PayPal. And you can mail a check to Consumer Action, a Timber Membership Giving at the 57 Post Street. If you enjoyed this webinar as much as you enjoyed the double latte, well, you know, send us the money for the double latte. If you're in California and you enjoyed it as much as an In-N-Out burger or a half a chicken at a Pollo Loco, send us the money and save yourself the calories today. Again, I would like to thank our speakers for taking the time out of their day to come here and to provide this information to you. As I stated earlier, the webinar is being recorded. You should receive a link by tomorrow afternoon. When you receive the link, please subscribe to our YouTube channel. It's free, and it's another way that you can continue to help us bring you these great webinars. A special thanks to our amazing speakers and a special thanks to our audience. I look forward to welcoming you back on January the 25th. And on behalf of the entire staff at Consumer Action, let me wish you happy holidays and the best this world have to offer to you in 2022. Thank you. Stay safe and stay sane. Goodbye.